So lenders are facing very interesting problems in the home equity portfolio. Home equity market actually presents an opportunity and risk at the same time for lenders. On one side, a big chunk of the increase in mortgage volume is expected to actually come from home equity. As home prices continue to stabilize and increase, there's equity that's built into the house, and the borrowers are going to tap into the equity by taking out home equity loans rather than refinance or move. Ironically, at the same time, banks are facing significant or potential significant credit risk from their home equity portfolio. 60% of all home equity loans are actually coming up for amortization in the next 3 years. So within the next 3 years, a big chunk of the loans are going to reset to a higher payment, and that could cause potentially a lot of delinquencies and could actually create a new wave of credit losses for the banks. So one of the mistakes the banks is making with respect to addressing the HELOC portfolio is basically because they have been so focused on their first mortgages that they have not paid attention to their HELOC portfolio. So they have not viewed the HELOC's portfolios as needing loss mitigation efforts. So they have not developed programs that actually are loan modification programs specific to the HELOC program. So another mistake that the banks are making is really is a failure to actually proactively reach out to the borrowers and understand the borrower's current situation, communicating with the borrowers that their payment might increase, so there might be a potential payment shock, and understanding the borrower's current credit scores, income levels, so that they can design programs that are suited for the borrower's current situation. The new guidelines are actually creating significant new requirements from the servicers. The servicers have to look at the portfolio, the HELOC portfolio in particular, and are required to follow several steps. There's notification requirements. So for example, if they're going to extend an interest-only term, they not only have to contact the borrower and get their consent, but they have to get the borrowers to provide the paperwork. Some of it needs to be signed and notarized. So that's one of the issues. The other expectation from the regulator is they really want the lenders with HELOC portfolios to look at their current portfolio, analyze it for risk, make sure that they are ahead of the game in terms of looking at the potential credit risks that's there in their HELOC portfolio. The other comment we see constantly from the regulators is they want the lenders to take action now. They want them to be proactive and get ahead of the curve and talk to the borrowers and design programs that are flexible for the borrowers. So banks can effectively address the situation by really dealing with it head on. So the solution lies actually in technology and in outsourcing. So banks have to analyze their HELOC portfolios and come up with really fast, consistent, accurate decisions that is appropriate for each borrower. So they have to look at their portfolios and come up with the solutions that suit it. So they have to develop a good loss mitigation program. They don't have to do this all in-house themselves. So one of the big good opportunities is really for the banks to bring in outsourced providers who have domain expertise, and they might also bring technology to the table that'll help really handle this impending mitigation and loss situation that's coming up so that the banks can continue to focus on their core activity.